What if the most dangerous moment in any economy is not the crash itself, but the years of brilliant, euphoric, seemingly unstoppable success that come before it? What if the very conditions that make people feel most confident about the future are the exact conditions that guarantee its collapse? That is the question at the terrifying heart of Andrew Ross Sorkin's landmark book, 1929. And the answer he delivers, meticulously researched over 8 years, should stop every investor, every policymaker, and every thinking person cold. Sorkin is not a casual observer of financial catastrophe. He is the man who wrote Too Big to Fail, the definitive account of the 2008 banking crisis. He co-anchors CNBC's Squawk Box and founded the New York Times Dealbook newsletter. He has spent his career embedded at the intersection of money, power, and consequence. When he turns his full attention to 1929, the result is not a dry history lesson. It is a human drama of breathtaking scale, told through the lives of the men whose ambition, blindness, and hubris dismantled the American economy and shattered a generation. This is the Book Vault. Today we are going deep inside 1929, examining every major arc of the book, extracting the mental models that explain how the crash happened, and identifying the strategic insights that remain urgently relevant in today's world. Because, as Sorkin himself says, the parallels between that era and our own are not subtle. They are unmistakable. By the end of this breakdown, you will never look at a bull market the same way again. If you want this level of deep strategic analysis every few days, hit subscribe right now and turn on the bell. This channel exists for people who think differently about money, history, and power. Now, let us begin. Part 1. The Architecture of a Delusion. Chapter 1. The Warring Twenties and the Invention of Collective Euphoria. To understand the crash of 1929, you must first understand what the 1920s actually felt like from the inside. Not from the safe distance of history, where the ending is already known, but from within the decade itself, where everything appeared to be getting better, faster, and more permanently than at any previous moment in human civilization. Sorkin opens the book by reconstructing that atmosphere with extraordinary precision. The 1920s were not just prosperous, they were intoxicating. Electric lights, automobiles, radios, and modern appliances were transforming everyday life at breathtaking speed. Progress was not a hope. It was a daily, visible, tangible fact. A government commission in early 1929, which included the future President Herbert Hoover, concluded that America had barely touched the fringes of its potentialities. Governor Al Smith of New York assured investors that the future promised eternal sunshine. Economists coined the phrase the New Era to describe what they believed was a permanent shift in economic reality, a world where boom and bust cycles were relics of a vanished age, replaced by continuous and compounding growth. These were not fringe views. They were the mainstream consensus of the most educated, most powerful, and most credentialed people in the country. Sorkin identifies the greatest product of the 1920s as neither the automobile nor the radio. It was credit. For the first time in American history, installment debt allowed ordinary people to pull the wealth of tomorrow into the present. You could buy a car today and pay for it over months. You could buy stocks on margin, putting up as little as 5 to 10% of the purchase price and borrowing the rest. What happens when prices rise is straightforward. Borrowed money magnifies your gains. What the euphoria prevented people from calculating clearly was the other side of that equation. When prices fall, borrowed money magnifies your losses with equal and merciless efficiency. The structural genius of Sorkin's opening is that he refuses to portray the 1920s as obviously foolish in retrospect. He shows you why rational people, looking at the evidence available to them in real time, could genuinely believe what they believed. The economy was growing, unemployment was low, technology was advancing. The optimism was not irrational given the inputs available. What was missing was the capacity to imagine systemic risk, to model the downside of leverage, to see that confidence itself had become the most dangerous variable in the system. That failure of imagination is not unique to 1929. It is a recurring feature of every speculative era in human history. Chapter 2. Sunshine Charlie and the Machinery of Speculation. The most fully realized character in Sorkin's book is Charles Edwin Mitchell, the chairman and chief executive of National City Bank, the forerunner of what would become Citigroup. Mitchell was known to the press as Sunshine Charlie, a nickname that captured both his relentless optimism and his extraordinary talent for making other people feel that optimism was not just warranted, but scientifically justified. He was charismatic, brilliant, and possessed of a salesman's genius for packaging financial risk as financial opportunity. Under Mitchell's leadership, National City transformed the business of banking. He pioneered the mass marketing of financial products to ordinary Americans. He built a retail banking operation that sold securities directly to the public, turning Wall Street from an exclusive club for the wealthy into something that felt democratic and accessible. People visited National City branches the way they might visit a department store, browsing investment products guided by salespeople who spoke the language of prosperity and growth. Mitchell had sold $12 billion worth of securities to the public by the time the crash arrived. Much of it would eventually prove to be nearly worthless. The Federal Reserve watched Mitchell's operation with growing alarm throughout 1929. The Fed, recognizing that speculative excess was building dangerous pressure in the system, issued warnings and attempted to raise interest rates to cool the market. Mitchell defied them directly and publicly. In March of 1929, when a market wobble threatened to become a genuine correction, Mitchell announced that National City would pump $25 million of credit into the market to prevent a panic. He positioned this defiance as patriotism, as the responsible action of a private institution stepping in where timid regulators had failed. The market soared. Mitchell was celebrated as a hero. Sorkin's treatment of Mitchell is one of the book's great achievements. He does not paint him as a cartoon villain. He shows you a man of genuine intelligence and enormous energy who had constructed a worldview in which his own success and the success of his institution were synonymous with the success of America itself. That identification, that collapse of the boundary between personal ambition and national interest, made it impossible for Mitchell to see the damage his actions were causing. He was not lying to the public, he was lying to himself first. And that distinction is far more frightening than simple fraud. Chapter 3. The Speculators, Pools, and the Architecture of the Market alongside Mitchell and the bankers. Sorkin introduces a cast of speculators whose activities were shaping market prices in ways that bore little relationship to underlying economic reality. Chief among them was William Durant, the founder of General Motors, a man of legendary optimism who had already lost one fortune and rebuilt it, and who in 1929 was operating pools that artificially inflated stock prices for the benefit of insiders. Durant and Mitchell were allies, united by their conviction that rising markets were always justified, and that anyone who suggested otherwise was a coward or a fool. The pool operations that Sorkin describes are a masterclass in understanding how financial manipulation works at scale. A group of wealthy insiders would quietly accumulate a large position in a stock. They would then conduct visible, active trading designed to attract public attention, driving the price higher. As retail investors piled in, attracted by the rising price and the appearance of momentum, the insiders would quietly sell their positions at inflated prices, leaving the public holding shares at valuations that had no rational foundation. This was legal. It was also devastatingly effective at transferring wealth from ordinary investors to a small class of sophisticated operators. Jesse Livermore presents the most strategically fascinating counterpoint in this section. Known as the Boy Plunger and the Hellhound of Wall Street, Livermore was one of the few figures in the book who saw what was coming. By early 1929, Livermore was quietly building a massive short position, betting that prices would fall. He was right about the direction. He was also, as Sorkin shows, largely alone in that position among the major players. Livermore's famous trading rule, that profits take care of themselves but losses never do, captures a discipline that was almost entirely absent from the broader market. When the crash came, Livermore made an estimated $100 million. He was also, tellingly, deeply unpopular for it. The man who tells an uncomfortable truth at the height of a boom is never celebrated. He is resented. Chapter 4. The Peak, September 3, 1929. Sorkin's chronological structure gives the book a quality that is almost cinematic. He covers key dates with novelistic detail, reconstructing the mood, the conversations, and the decisions of each pivotal moment. September 3, 1929 is one of the most precisely rendered days in the book. The Dow Jones Industrial Average closed that day at 3081.17, the highest point it had ever reached. The market had been climbing for nearly a decade. There was no obvious catalyst for concern. The newspapers were bullish. The economists were reassuring, and within weeks, everything would begin to fall apart. What Sorkin captures brilliantly about this peak is the total absence of any sense that it was a peak. The participants were not looking at the horizon for signs of trouble. They were looking at the numbers which kept going up, and at each other, who kept buying, and at the institutional authorities, who kept reassuring them. The social proof of universal participation had become its own form of evidence. If everyone is doing this, it cannot be wrong. If the experts approve, the skeptics must be mistaken. This logic, which feels absurd in retrospect, was the operating system of the most financially sophisticated city in the world in the autumn of 1929. The book traces the growing unease of a small number of figures who recognized something was wrong but found themselves systematically dismissed or ignored. William Crawford, the superintendent of the New York Stock Exchange, was made uneasy by the throngs of tourists who gathered outside the exchange simply to be near the spectacle of wealth. His unease was not based on a precise economic analysis. It was based on the human intuition that something this popular, this universally celebrated, this completely free of doubt was not sustainable. He was right, and his correctness earned him no credit, because it was the kind of correctness that could only be confirmed by catastrophe. Part 2. The Collapse and Its Human Consequences. Chapter 5. Black Thursday and the Banker's Intervention. October 24, 1929. Black Thursday arrived not as a single dramatic event, but as a gathering flood. By the end of trading that day, 13 million shares had been dumped as panicked investors rushed for the exits simultaneously. The ticker tape machines, which printed trade prices, fell so far behind the actual trading that investors could not get accurate information about what their holdings were worth. The mechanical infrastructure of the market could not process the speed of human fear. The response of the banking establishment was swift and, in the moment, appeared to work. Thomas Lamont of J.P. Morgan organized a coalition of the most powerful bankers in New York. They pooled their resources and tasked Richard Whitney, the acting president of the New York Stock Exchange and a man of imposing physical confidence, to walk dramatically onto the trading floor and place a large, visible, above-market bid on U.S. Steel stock. Whitney became known that day as the White Knight, the man whose bold action had halted the slide. The market rallied. The intervention appeared to have worked. Sorkin uses this moment to make one of the book's most important strategic observations. The coordinated banker intervention of Black Thursday is remembered as a success because the market did temporarily stabilize. What is forgotten is that it was a temporary stabilization built on the same confidence that had driven the bubble in the first place. The bankers were not addressing the underlying imbalances. They were performing confidence. They were telling the market that the important people believed everything was fine, and the hope that belief would become self-fulfilling. It worked for 4 days. Then came Monday. Chapter 6, Black Monday, and Tuesday the collapse completes. October 28 and 29, 1929, the days history remembers as Black Monday and Black Tuesday are where Sorkin's narrative reaches its most devastating momentum. On Monday, the Dow fell 13%. The previous day's intervention by the bankers had proved to be nothing more than a pause. The underlying selling pressure had not been addressed. It had merely been delayed. When it resumed with additional force, as investors who had held through Thursday in hope for recovery now panicked in earnest. On Tuesday, October 29, the market collapsed completely, falling an additional 12%. It was the single worst day in the history of the New York Stock Exchange to that point. Jesse Livermore, having shorted the market, made a fortune that his own trading rules had helped him position for perfectly. Meanwhile, Charles Mitchell learned that his bank had made a catastrophic error. Caught up in the chaos, National City's portfolio management team had purchased 70,000 shares of the bank's own stock in an attempt to support the price, a purchase the bank could not actually afford to finance. Sorkin's recreation of Mitchell's walk back to his office on the evening of Black Tuesday is one of the most powerful pieces of writing in the entire book. Mitchell, the Sunshine Charlie, whose optimism had been the market's most potent fuel, walked through the streets of downtown Manhattan and collapsed into the chair behind his mahogany desk. The grandfather clock ticked. The portraits of George Washington looked down, and the man who had spent a decade being celebrated as a financial genius confronted the reality of what his certainty had cost himself and his depositors. The human scale of the reckoning is what makes the historical scale comprehensible. Chapter 7. The Human Wreckage and the Anatomy of Ruin. Sorkin does not allow the crash to remain an abstraction of numbers and institutional behavior. He insists on the human cost, and the portraits he draws are devastating. On November 8, 1929, James Reardon, the president of County Trust Company, ended his own life after suffering catastrophic losses. He was not the only one. Groucho Marx, who had borrowed on margin based on a broker's assurance that Wall Street had become a worldwide market where prices would rise forever, lost his fortune when the broker simply shrugged and said, "I guess I made a mistake." The margin call mechanism that Sorkin explains so clearly is crucial to understanding why the crash moved so fast and so far. When stock prices fell, investors who had borrowed to buy on margin received margin calls, demands to put up more cash or sell their holdings. Investors who could not pay their margin calls had their stocks sold automatically by their brokers. Those forced sales pushed prices lower, triggering more margin calls, triggering more forced sales. It was a feedback loop of destruction, and it operated with mechanical speed and no mercy. The leverage that had magnified the gains of the boom now magnified the losses of the collapse with perfect symmetry. By 1929, women had made up 20% of market speculators. Brokerages had installed special lounges for them. Critics had claimed they were temperamentally unsuited to trading while simultaneously taking their money. When the crash arrived, those criticisms were forgotten entirely, replaced by the simple arithmetic of ruin. People who had borrowed against their homes, their savings, their futures, found themselves not merely back where they had started, but in depths of debt they had never imagined possible. The wealth of tomorrow that credit had pulled into the present had evaporated. What remained was the debt. Chapter 8, Herbert Hoover, Denial, and the Failure of Leadership. President Herbert Hoover's response to the crash represents one of the most instructive case studies in the book on the cost of institutional denial. Hoover was not a stupid man. He was, in fact, one of the most technically accomplished presidents in American history, an engineer by training, a gifted administrator, a man who had organized massive humanitarian relief operations in Europe after the First World War. But in the face of the crash and the depression that followed, his deep ideological commitments made him catastrophically slow to respond. Hoover's first instinct was linguistic management. He changed the official terminology from the word panic, which had historically described financial crises, to the word depression, which he believed sounded less alarming. Sorkin notes the terrible irony of this choice with characteristic precision. Panics, historically, are short. They are sharp, violent corrections that resolve relatively quickly. Depressions are long. They can last a generation. In attempting to calm public anxiety by softening the language, Hoover had accidentally chosen a word that far more accurately described what was actually coming. Meanwhile, Treasury Secretary Andrew Mellon, who had served under 3 presidents and represented the pure laissez-faire ideology of the era, counseled Hoover to liquidate labor, liquidate stocks, liquidate the farmers, to let the system purge itself of excess. This philosophy, that the crash was a natural and necessary correction, requiring no government intervention, was not fringe economics. It was the dominant view of the most credentialed economic authorities of the era. And it was spectacularly, catastrophically wrong. Unemployment soared, banks failed, the economy contracted, and Hoover, committed to the ideology that would not allow him to act, watched it happen. Chapter 9, The Reckoning, Investigations, and Reform. The political aftermath of the crash is where Sorkin's book transitions from economic drama to something closer to a morality play, though one without simple heroes or villains. Senator Carter Glass, a Virginia Democrat who had been warning about speculative excess for years, now led the charge for accountability. Ferdinand Pecora, a Sicilian-born assistant district attorney from New York, became the lead investigator for the Senate Banking Committee and proved to be one of the most formidable interrogators in American political history. Pecora's investigation of National City Bank exposed practices that shocked even a public that had already witnessed the destruction of the crash. He revealed that Mitchell had received massive bonuses while misleading investors about the quality of the securities his bank was selling. He exposed how bank insiders had used customer funds and manipulated markets for their own benefit. Mitchell, Sunshine Charlie himself, was eventually arrested for tax evasion in 1933. The man who had stood on the steps of his bank while tourists gathered to see him, the man whose confidence had been the market's most powerful marketing tool, faced a criminal indictment. Richard Whitney's story delivers the book's sharpest final irony. Whitney, the white knight who had placed the heroic bid on Black Thursday and become a symbol of Wall Street's ability to rescue itself, was exposed years later as an embezzler. He had been pilfering millions from the New York Stock Exchange's gratuity fund and from the New York Yacht Club to cover his own bad debts. The man held up as proof that Wall Street could police itself had been systematically looting the institution he appeared to be defending. He went to prison. The institution he had robbed survived and reformed. but the image of private self-regulation as a sufficient safeguard was permanently shattered. Chapter 10. Glass-Steagall, the SEC, and the Architecture of Reform. The final arc of Sorkin's book follows the political and legislative response to the crash, and it is here that the historical stakes become most clearly legible. The crash did not just destroy fortunes, it destroyed a philosophy, the belief that unregulated markets would self-correct, that private actors would be disciplined by the consequences of their own decisions, that government intervention in financial markets was both unnecessary and counterproductive, was not merely challenged by 1929. It was empirically annihilated. The Glass-Steagall Act of 1933 separated commercial banking from investment banking. Commercial banks, which held ordinary depositors' savings, could no longer also operate as investment banks, taking those deposits and using them to fund speculative market activities. This was a structural response to one of the core problems Procora's investigation had exposed: the conflict of interest between an institution that owed a duty of care to its depositors and an institution that was simultaneously trying to profit from financial speculation. The wall Glass-Steagall built between these functions was not perfect, but it held for decades. The creation of the Securities and Exchange Commission in 1934 represented an equally fundamental shift. For the first time, the federal government would systematically regulate financial markets, require disclosure, and enforce rules designed to prevent the manipulation, insider trading, and misleading sales practices that had characterized the boom years. The SEC was not created by ideologues who hated capitalism. It was created by pragmatists who understood that capitalism without effective regulation was not a free market. It was a machine for transferring wealth from the uninformed to the well-connected. These reforms are Sorkin's quiet but insistent answer to anyone who asks what 1929 ultimately produced. It produced the regulatory architecture that prevented a comparable collapse for the next several decades: the mental models. 5 strategic insights from the crash of 1929. Mental Model 1, the collective delusion effect and the danger of universal consensus. The most important cognitive insight in Sorkin's entire book is the mechanism he identifies as collective delusion. He describes how lengthy, uninterrupted booms produce a shared psychological state in which optimism becomes a drug, risk calculation atrophies, and the ability to distinguish between good ideas and terrible ones erodes completely. The delusion is not imposed from outside. It is generated from within. It is the product of the very success that precedes it. The strategic application of this mental model is critical for any investor, leader, or institution operating today. When every credentialed authority agrees, when pessimism has gone out of fashion, when the consensus is that this time genuinely is different, those are precisely the conditions that historically precede the most severe corrections. The absence of visible doubt is not evidence of safety. In a speculative environment, it is evidence of maximum danger. The Sorkin model suggests that the smart strategic position is always to ask what the consensus is missing, to seek out the unconventional analysis, and to treat universal agreement as a warning signal rather than a comfort. Mental Model 2. Leverage is the amplifier of both directions. The margin lending system of the 1920s is the mechanical heart of why the crash was so severe. And the principle it illustrates is one of the most important and most consistently misunderstood in all of finance. Leverage amplifies outcomes. It does not distinguish between good outcomes and bad ones. It simply multiplies whatever is happening. In a rising market, margin creates the illusion that you are a genius. In a falling market, it creates losses that exceed your original investment and can cascade into insolvency. The practical application of this mental model extends far beyond personal investing. Any organization that builds its operating model on leverage, whether financial, operational, or reputational, is creating a structure that performs brilliantly in favorable conditions and collapses catastrophically in adverse ones. The 1929 model suggests that the sophistication of a financial or organizational structure should be measured not by how well it performs at the peak, but by how much damage it does in the trough. Structures that produce spectacular gains in the good times while generating systemic destruction in the bad times are not sophisticated. They are fragile. Mental Model 3. The credibility trap. When reputation prevents correction, Charles Mitchell's story illustrates a phenomenon that Sorkin does not name explicitly, but which runs through every chapter of the book: the credibility trap. Mitchell's public identity had become so completely fused with the idea of rising markets and permanent prosperity that he was psychologically and institutionally incapable of communicating doubt or concern, even when he privately felt it. To admit uncertainty would have been to destroy the confidence that was his primary product. The trap closed gradually, then completely. This mental model applies with devastating precision to any leader whose public identity is built on a single narrative. When the world requires that narrative to remain consistent regardless of changing facts, the leader loses the ability to adapt. They cannot issue corrections without destroying credibility. They cannot change course without admitting they were wrong. And in high-stakes environments, the inability to adapt is not just uncomfortable, it is fatal. The Sorkin lesson is that leaders must preserve the internal capacity for doubt even as they project external confidence, and must create institutional structures that can surface uncomfortable information before it becomes catastrophic information. Mental Model 4, the regulatory capture cycle. And the limits of self-policing. The relationship between the Federal Reserve, the banking establishment, and the political system in the late 1920s is a textbook example of regulatory capture. The institutions responsible for monitoring financial stability had been so thoroughly integrated into the culture of the boom that they lacked both the independence and the will to impose meaningful constraints. When the Fed tried to raise rates, Mitchell simply overrode them publicly and was celebrated for it. When warning voices inside the system raised concerns, they were dismissed or marginalized. The regulatory function had been captured by the ideology it was supposed to regulate. The strategic application of this insight is relevant to any organization, industry, or system that relies on internal self-regulation. Self-policing works reasonably well in environments where the incentive to behave well and the incentive to behave badly are roughly in balance. In environments of extreme profitability, where the short-term rewards for rule-bending are enormous and the long-term consequences are diffuse and distant, self-policing systematically fails. The historical answer, as 1929 ultimately demonstrated, is structural independence. Regulators must be insulated from the institutions they regulate by design, by law, and by culture. Richard Whitney's embezzlement was not an anomaly. It was the logical endpoint of a system that had asked the regulated to police themselves. Mental Model 5, the gradually then suddenly principle of systemic failure. Sorkin borrows a phrase from Hemingway to describe how the financial collapse actually unfolded. How did you go bankrupt? Two ways: gradually, then suddenly. This is not merely a literary observation. It is a precise description of the mechanics of systemic failure in complex systems. The conditions for collapse accumulate slowly, invisibly, across years of apparently normal operation. Then, when a threshold is crossed, the failure is catastrophic and nearly instantaneous. The strategic implication is one of the most practically valuable in the book. Because systemic failures appear sudden, they are almost always diagnosed as being caused by whatever happened in the final days or weeks before the collapse. The October crash is remembered as the cause of the Great Depression. Sorkin shows, with exhaustive precision, that the crash was the effect of conditions that had been building for a decade. The real causes were the leverage, the regulatory failure, the collective delusion, and the structural conflicts of interest that had been accumulating since the early 1920s. Any serious strategy for risk management must therefore look not at the last visible trigger, but at the accumulated structural conditions that made the trigger catastrophic rather than merely inconvenient. The vault closing, there is a sentence in Sorkin's book that deserves to be read slowly more than once. He writes that the greatest product of the 1920s was not the car or the radio, but credit. That credit drew the wealth of tomorrow into the present, and that the problems arose when people got greedy and took too much. That sentence is not a historical observation. It is a mirror held up to the present. The mechanism Sorkin documents, the leverage, the collective delusion, the conflicts of interest, the regulatory capture, the credibility traps that prevent leaders from telling uncomfortable truths, are not relics of 1929. They are features of every financial era. They were present in 2008. They are present today. What makes Sorkin's work more than financial history is the insistence that behind every data point is a human being making a decision under uncertainty, with incomplete information, motivated by fear and ambition, and social pressure and the very human desire to believe that the good times will continue. The people in this book were not stupid. They were not uniquely corrupt. They were, in the most sobering possible way, recognizably human. And their recognizably human decisions produced a catastrophe that shattered millions of lives and reshaped the architecture of the American state. This has been the Book Vault's deep dive into 1929 by Andrew Ross Sorkin. If this kind of strategic, historical analysis of the forces that shape markets, institutions, and human decisions is what you are looking for, then this channel is exactly where you need to be. Subscribe so you do not miss the next breakdown. Leave a comment and tell us which mental model from today's session resonates most with what you are seeing in the world right now. And go back to whatever you are investing in, whatever you are building, whatever you are trusting, and ask yourself the one question this book demands. What are we not seeing because we do not want to see it? That question, honestly answered, is the beginning of genuine financial intelligence.